that's where you need the reforms of the financial system, of the central bank, moving to an independent central bank, and economic structural reforms of the economy as well, to get the potential to have long-term sustainable growth.
With a Master's in Econometrics and Mathematical Economics from the London School of Economics and Political Science, Professor Grant Spencer has held several senior positions at the Reserve Bank of New Zealand from 2007 to 2017 until his eventual retirement in March 2018 while in office as the acting governor. During his tenure as the Deputy Governor and Head of Financial Stability at the Reserve Bank of New Zealand, Professor Spencer oversaw prudential regulatory and supervision functions along with macroprudential policy and the bank's financial market operations. Professor Spencer has also served as non-executive director to the New Zealand Institute of Economic Research and as a council member of the New Zealand Corporate Treasurers Association. Following his experience as part of the senior management at the ANZ Banking Group, Professor Grant Spencer was also the alternate executive director to the IMF. His research interests include financial regulation, the financial system, and international finance. Using his vast experience working in research, Professor Grant Spencer has made several notable publications in these research areas, among others. Professor Spencer has also chaired the Committees for Financial Markets in both the Organization of Economic Cooperation and Development and the Executives Meeting of Asia Pacific Central Banks.
Our discussion today will center around the economic crisis and particularly on how governments and central banks have undertaken reform in the face of crises. Today we have with us Mr. Grant Spencer, former Deputy Governor of the Reserve Bank of New Zealand. He was also the acting governor for 6 months prior to his retirement. He was the head of the Financial Stability Division at the Reserve Bank of New Zealand from 2007 to 2017, where he oversaw the prudential regulatory and supervisory functions of the Reserve Bank, as well as macroprudential policy and the bank's financial market operations. He has also held senior positions at ANZ Banking Group and was also an alternate director at the International Monetary Fund. Welcome to Sri Lanka and thank you for being with us today.
Thank you. Pleasure to be here.
Before we get on to our topic for discussion, for the benefit of our viewers, we would like to hear a little bit from you about your background and how you ended up at the Reserve Bank of New Zealand.
Well, my studies early on were in economics and mathematics, and I got into what was a new area of econometrics at university. And so when I started at the Reserve Bank, I was model building. So this was what attracted me to go to the Reserve Bank, was the use of statistical methods and model building to build forecasting models. This is when the central banks started doing this, back in the late 70s. And the central banks were doing it all around the world. So that's I got into central banking in the research model building side, but then moved eventually into policy areas, monetary policy and then financial stability, and then, moved in different directions, but I've generally been in the sort of finance and economics area.
So you moved to the ANZ banking group, so basically from the private banking sector to public sector. How did your experience at ANZ, the banking group, sort of help you in your work?
Well, I think it was very helpful. I'd spent time at the Reserve Bank and moved into the markets area with the market operations, foreign exchange, foreign reserves management, etc. So I wanted to have some private sector experience. So that's why I moved to ANZ to get that market experience, to see what it's actually like to work in the private markets. And then, in turn, when I eventually came back to the central bank, that was very useful just in terms of understanding how banks operate, how bankers think, and why they make decisions, how they make decisions. So if you're a banking supervisor, regulator, it's good to understand how the markets actually operate. So I found that very beneficial, very useful.
And is that something that is common in the Reserve Bank of New Zealand and also even in the public sector? Is there sort of lateral movement from the private sector to public sector and back? And would you recommend that?
I would recommend it, but it's not very common for various reasons. There is some movement, but generally once people move into the public sector, they tend to move around the public sector but stay in the public sector. A lot of new graduates will join the public sector, say the Treasury or Reserve Bank for a couple of years, and then go out to the private sector. So a lot of, for example, the economists in the private sector were previously, in the central bank or Treasury to start for this sort of training. But it tends to be a one-way flow. The young graduates, then they go out to the private sector. It's less common to come back at the management level.
I believe you were at the RBNZ during the global financial crisis, and you're probably heading the prudential, the financial stability department at that time. So how did your sort of experience with being in the, what was the experience during that time?
Well, yeah, the GFC was a momentous time. Every country was dealing with a major financial shock. New Zealand, the shock was not as bad as some other countries, for example, in Europe or North America. And the main shock that New Zealand had was a liquidity shock, where it was very difficult to raise cash, and the banks found it difficult to refinance their funding. But they didn't have a solvency problem, so they weren't failing, but they needed liquidity. So the central bank is a natural supplier of liquidity. That's their duty, to provide liquidity to the system. So during that time, the main thing we did was generate a lot more funding for the banks during that transitional, very tough period. And so it was, you might call that lender of last resort. And so that's a legitimate function for the central bank, and you have to be a little bit innovative, and I think the Central Bank of Sri Lanka is the same. They need to think about new ways to provide liquidity to the banking system in this environment that may not be the usual way of doing it. Particularly, there's a need to, say, have some term funding, some longer term funding, rather than just short-term funding that's rolling over. But the more difficult area is when you have a solvency crisis in a bank. In New Zealand, we had a couple of insurance companies that fell over, and we had some finance companies that fell over. And they were mainly dealt with through the courts, through the commercial liquidation process. So the central bank, we didn't have to deal with any major bank solvency issues. In those situations, if there is a solvency crisis, then the central bank can't solve that on its own. The government needs to step up. If there's going to be any use of bailout funds, for example, that has to be a government decision. Because the central bank is for lending, for secure lending. It's not for equity injections. And so if the situation does arise in Sri Lanka where banks are in trouble, then it needs to be a joint effort between the central bank and the government in terms of how to resolve that issue. Ideally, the central bank and government should anticipate the problem. And if you can anticipate it to try and resolve it early, will be less costly than if you wait for the failure. But in the GFC, it's very difficult for central banks or governments to anticipate these situations. Usually it's a boof, it's a surprise to everyone when it happens. But then they have to react, they have to manage it.
That's good advice for us and for our bank regulators, because I think this is something that we'll have to deal with going forward. But just going back to sort of the 1980s, when I think New Zealand went through quite a severe economic crisis. The country was running very large current and fiscal deficits. I think the government debt was quite high. We had rising inflation. The exchange rate was under pressure. In fact, It depreciated, I think, quite significantly at that time, despite all the measures that were taken to maintain the exchange rate. Not very unlike what Sri Lanka has been going through in recent times. So could you tell us a little bit about the background to this crisis and what was the role of the government in a sense? Because I think there was quite a lot of government intervention at that time.
Yes.
So just a little bit about the background to that.
In the sort of late 70s, early 80s, the government became more and more interventionist. There had been earlier periods where there'd been reform or attempts to open up. But then we had a government that wanted to sort of control everything, to control the economy. And they were managing it. We had a prime minister who was also the Minister of Finance, and he was looking to control a large sector of the economy. And after the oil shock of the late 70s, and also there was an international recession at that time, and interest rates were going up as the major economies were trying to take inflation out of their system. So this is when Volcker and co were pushing interest rates up. So the international environment for our exports became tougher. Our terms of trade were deteriorating, but in New Zealand and the government, they were trying to live beyond their means. They wanted to keep the living standards up. So the deficit increased, the fiscal deficit, the balance of payments deficit. As you say, the debt went up. We had inflation. And so it got worse and worse, and then there was a political crisis and a change of government. And then we had a foreign exchange crisis as well. And as I say, the exchange rate was devalued by 20%. And the new government came in and said, we have to try something different. This old economic model, it doesn't work. So we need to do things differently. So then they set about a reform program. And, the first thing was financial stabilisation, of trying to balance the books, of trying to bring inflation down. But then there was also the reform program of structural reforms, financial deregulation, and the reform of SOEs. And there was a privatisation program, and changing incentives in the economy. But the stabilisation came first, and then financial deregulation, and then real sector reforms. That's sort of ordering.
So this was a real comprehensive reform program.
It was, yeah.
How did the government of that day, which had just sort of taken office, I think it was the Labour government at that time, how did they actually build consensus for this reform program among its own constituents or members, as well as the electorate at large? What was that?
Well, it was a Labour government, so it was a bit of a shock to many people, because this is a centre-left government doing all these reforms and market deregulation. So a lot of people, a lot of the traditional Labour supporters were a bit surprised. But so in other words, it hadn't been in their manifesto before the election. There'd been some hints of it, but it wasn't obvious that this is what they were going to do. So it's like when they got into power, they said, we've discovered all these problems, we have to do things differently to what we were thinking. So there was a concerted effort and communications effort from the senior members of the government. The Prime Minister, David Lange, the Minister of Finance, Roger Douglas. The Minister of Finance was the main designer of the reform program, but he had full support from the Prime Minister, or most of it anyway. And then the other senior members of Cabinet, they were all out there giving speeches, communicating, selling the program and saying, this is what we need to do. The old model doesn't work, we need to do this. So there was a big effort from those senior members of the government to sell the reforms to the general population.
So in a sense, there was sort of a buy-in from everybody, because I'm sure this kind of, when you undertake, and Sri Lanka is in that process, it has to undertake a slew of economic reforms, which I think requires a vast amount of experience, resources, or expertise actually from the government. And how was that sort of expertise mobilized within the New Zealand government? And as you said, were there some champions who actually championed this program?
Yeah, well, the main champion was the Minister of Finance and the Prime Minister, but the sort of engine of the designers were mainly based in Treasury, Ministry of Finance, with support from the central bank, the Reserve Bank, where I was, and then other people in the, in the public sector and in think tanks, etc., that were contributing. But there were some people, of course, who did not buy into it. I mean, and in particular, people who were most adversely affected by the transition, because in the transition, subsidies removed, exemptions removed, so there are some sectors that are badly hurt. And in particular in New Zealand, the sector most hurt were the farmers, because initially the exchange rate went up, the terms of trade, their prices were down, and they had subsidies removed, and so some in the farming sector were badly hit, and they found it very hard to accept. And if you look back on it, they probably should have had more support, in terms of the government needs to try and support the most badly affected. But when everything's changing, it's sometimes hard to actually target the assistance as it's needed. But generally there was support in the broader populace. There was agreement that change was needed.
So basically, I think when you look at this kind of reform program, I think you alluded to it, there's some kind of sequencing. But does the sequencing come first, or is it sort of depending on what is easier to get done, or is there some kind of process that you have to follow in terms of the sequencing of reform? Is it a linear process? And how long did this process take?
Well, I think in general, people agreed that you need to try and stabilise the situation, the financial imbalances first, and that's what you tackle first. Then you move on to the more structural reforms. In our case, the structural reforms, in particular the financial deregulation, happened quite early in the piece. So it happened early relative to the real sector reforms. And that can cause quite a lot of volatility, but some of the financial deregulation was needed to help with the stabilisation, such as floating the currency, for example, and deregulating the banks. So in order to stabilise the financial system and to stop monetisation of deficits and to get control of the money supply, we actually needed to float the currency. But there was still, say, a gap. Like the initial reforms were, say, in 1984, and then a year later we floated the currency. So we kept and managed the currency for a year before we floated it. So, there was some preparation and stabilisation, but the financial deregulation still was relatively early in that sequencing process, ahead of the real sector restructuring like privatisation and this sort of thing.
So I'm sure there was, as you alluded to it, there were sectors in the economy that bear a disproportionate amount of maybe the pain from reform process, and you alluded to the farmers. How did the government actually tackle that, and was there some kind of sort of support given to those sectors? And
yeah, there was support given, but it was still very tough for a lot of farmers. And for example, the banks tended to give forbearance on the credit, so that the farmers couldn't afford to service their mortgages, their loans. And so some of the banks were tough, but others were more patient, waiting for, giving the farmer some breathing room before requiring them to repay the loan. So a bank can be tough and come and say, no, we want the loan, sell the farm. But if that happened, it was just going to drive down the price of farms and land very quickly. So the banks generally tended to back off and give the farmers some room.
Because I think Sri Lanka is also going to go through this reform process. So how do we prepare? How does the government prepare? How do policymakers prepare? How do the people prepare for this kind of reform program? What should they expect? And how long do you need to, how long does it take to sort of complete this kind of reform program?
Well, it takes many years, really. It doesn't mean to say you have to be in pain for a year. So, the initial period is going to be more painful, and then it will start to come right. But you don't really get into the benefits of the new framework for a number of years. And so the leadership of the government have to make that very clear to people. But they also, have to make it clear how to manage their way through it and what assistance will be provided. The leadership of the government in terms of that reform process is very important.
So I think moving back to the economic crisis and what you faced, looking at Sri Lanka, basically we've had one of the big issues has been with the central bank and the financing of the deficit, which has basically led to a high level of money supply, feeding into inflation, currency depreciation, etc., and the consequences of which we are still sort of trying to come to terms with or grappling with. So I think one of the major areas of reform during that time was on the monetary side, where the central bank had this single target or went into an inflation targeting framework. Yeah. And I think New Zealand was the pioneers really in adopting inflation targeting, as well as having operational independence, being given operational independence. What was that process that New Zealand went through to come to that position?
Right. Well, initially the emphasis was just on financial stabilisation and getting inflation down. So we were having a tight policy, but it took probably 4 or 5 years before the reform happened, the move to inflation targeting, and where the Reserve Bank Act was changed. So that initial period was just trying to stabilise things. But the reform, which had the main elements of an independent central bank that is accountable, but it has a clear price stability target. Those 3 things. That is the essence of inflation targeting. And that came out of, I would say, a broader public sector reform effort in New Zealand. So Roger Douglas, the Minister of Finance, he was saying, how do I improve the management and accountability of the public sector? So there's all of these state entities, state enterprises and sort of independent entities, sort of like the central bank or other state entities. He said, I want to set up their governance so that they have someone who's in charge with clear objectives, and I'll give them independence, but they have to be accountable for their actions and whether they achieve their objectives or not. So he was applying that model across different parts of the public sector, including the Reserve Bank. So the Reserve Bank said, okay, we'll do this to, you know, what's our target? Should be price stability, that's what we can achieve. How do we set up accountability? And how do we implement operational independence of achieving that target? So it was part of a broader public sector reform.
Oh, so really part of the central bank becoming independent, and I think part of it was really the Treasury officials moved out of decision making within the central bank,
yes,
which was part of the thing of strengthening the independence. But the accountability was not only with the central bank, it also was across all other, sort of the whole public sector.
Yeah, as a general approach to the public sector management. I mean, not so much government departments, permanent departments, but sort of state entities that are slightly SOEs and entities that are slightly outside of the core public service. This is the model he was trying to apply in slightly different ways. But this is, it made sense also in a central bank because of the issue of, in the previous model, the Minister of Finance had been deciding monetary policy. He called up the governor and said, interest rates up, down, he was giving the orders. But when politicians give the orders, make the monetary policy decisions, they have a much shorter term horizon than is appropriate for price stability, because monetary policy takes medium to long term to achieve price stability. You change monetary policy and it takes 12 to 18 months to have the full effect. So it's not amenable to political cycle decisions that might be influenced by politicians. And so this was another good reason to shift the decision making from politicians to independent bureaucrats, shall we say, boring bureaucrats who just have their eyes focused on that medium-term objective of price stability.
So I think in the central bank it's kind of now become very commonplace to have these sort of objectives or clear objectives set, and then the central bankers, they're asked to achieve those objectives. It's less clear how that is done in the rest of the public sector, but do you have some idea of how it was rolled out in other areas of the public sector in terms of having targets or performance measurement targets?
Well, some SOEs, for example, New Zealand owned utilities like power companies and things, and they had a mix of commercial and social objectives, shall we say. And he really moved to commercialise them. So if it was like a business, like a power company, he basically gave them a profit objective, a profitability or risk-adjusted return on assets, more commercial. So the aim was for these sort of trading enterprises to be much more commercial and have clear objectives in a commercial sense. And then once they were commercialised, then down the track they looked at potentially privatising as well. But they had to have that first step of putting them on a good commercial basis before moving to privatisation. But that was that clear objective for many of those entities was really a commercial objective.
Looking back, what do you think, what was the experience of New Zealand in terms of those reforms? Has it held out up to now? Have you had to undertake reforms subsequently, or?
Well, generally, most of those changes are still in place. There have been some parts of the economy where different governments have changed things. For example, labour market regulation tends to still shift depending on whether you have a Labour government or a national, centre-right or centre-left government. But most of the core reforms of the institutions are still in place. And so they've achieved a lot of benefits that, the population, I think most people in New Zealand realise that those changes were needed, and they're sort of happy with the new world that we live in. For example, the floating exchange rate, everyone just accepts it as an everyday part of life. There's no drama. No one ever questions it. No one ever says, we should go back to a fixed exchange rate. So some of these things just become part of the furniture eventually. And, I think New Zealand's economic performance through that period has been a lot better than it would have been if we'd stayed in the old regime.
So I think there's much criticism and opposition for the reforms that are being undertaken in Sri Lanka, and getting everybody on board is going to be, I think, a very difficult proposition for the government in power. But does Sri Lanka, from what you have seen and probably heard from your meetings with people, does Sri Lanka have an alternative? Is there another path that it can take? Or what would you say in terms of the process that Sri Lanka will have to go through to get out of this crisis?
What you're going through now, Sri Lanka's going through now, is stabilisation of the central bank trying to get on top of inflation. The government knows it has to balance its books because it can't live beyond its means anymore, because the foreign creditors, there's no more money coming from overseas. It's only coming from the central bank, and that's monetised and would just add to inflation. So they know they have to stabilise the finances. Now the question is, okay, when you get back to a stable situation, does it generate start to have the same problems again, or can you get onto a long-term sustainable growth path? And that's where you need the reforms of the financial system, of the central bank, moving to an independent central bank, and economic structural reforms of the economy as well, to get the potential to have long-term sustainable growth. And I think that's what the country is capable of, and that's what they should be aiming for.
Okay, so I think thank you very much for sharing your experience, the experience of New Zealand in undertaking reforms. I think there are many lessons for Sri Lanka in this process. Particularly, I think we need to undertake policies on a broad front. There needs to be policy consistency and credibility by setting targets, as you rightly mentioned, and also ensuring that there's no policy reversal, and also building up sort of a competitive environment, less intervention from the government, and allowing the markets really to operate. So I think thank you again for being with us and for sharing your insights. Thank you.
Thank you. It's a pleasure.